Hi, so this is the third quarter presentation. Let's first of all take a look at the performance over the last quarter. And people in this group meeting are balanced and some are growth. So I'm going to be uh, doing both. And I'll show you the results and some of the things for both types of investor. So this is the growth model. In the third quarter, we're up a little bit less than 1%. The Toronto Stock Exchange was up 3.7%, and the growth blend was up 2%. So this is what our target is growth blend. And on a year-over-year basis, we were up almost 10%, while the target was up about 5.5%. So, and when we look back at the year-over-year numbers in the past, 2015 was quite a bit better when the market went down. And in 2016, we did great when the market was good. So the market might be in sort of a transition phase at the moment, and that's something we'll be discussing. This is the balanced portfolio model. Once again, slightly less rate of return. The model portfolio where balance was lower, and that's because the bond market did very poorly. So having this 50-50 blend of stocks and bonds, the target portfolio was doing worse because of bonds doing so poorly. But on a year-over-year basis, we're at about 6% when the target of 50-50 stocks and bonds was at 3. So still doing well. I mean, we did incredibly well in 2016 versus the model or versus the target. And here back in 2015, we're up when the market was down. So, it's we'll be looking ahead to doing much better than the markets going forward. So every time we meet, I'll be talking about the big picture because that determines, how much we have in stocks versus out of stocks or in fixed income. We have a flexible approach. If things are safer than normal, we want to have more stocks and take advantage of the stock market going up. And if we're more dangerous than normal, we want to have less, and that sort of thing. So the three things are valuation, is the market cheap or expensive, sentiment, and the economic outlook. And every time we have one of these meetings, I'll be zeroing in on one of these things to show you a little bit more in depth. And this time, before we did valuation, last time we were sentiment, let's take a look at the economic outlook. So this is the U.S. leading economic indicator. And it's a group of economic indicators such as like new orders, consumer buying intentions, et cetera, et cetera. So things that are looking forward to see if the economy should be getting better or worse in the future. And what we see here is that this leading economic indicator is going up and up and up, which is says that there's no recession on the horizon. If we look back in the past, the top of the U.S. stock market was right about in here, back before the crash in 2008-9. So what we see there is that this leading economic indicator was falling for almost, better part of a year before the stock market had a peak. So this indicator gives us a warning of a recession. And you can see how the economy fell so dramatically during the great financial crisis. So it's so from this standpoint, it's saying that the economic outlook is very good. And we can see that in places like China, Europe, Far East, globally, in fact, the economies are doing well. So the economic outlook is positive. Now, with interest rates starting to go up, somewhere in the distant future, that could bite and cause a recession down the road somewhere. But as far as anything in the next 6 months or so, we'd have to say this is positive with, like I say, potential clouds farther into the future. So the other areas, valuation, earnings of the companies in the stock indexes are going up almost as much as the stock market is. So, last month we talked about the market being somewhat expensive, and I'd have to say that that's still the case. So this is not a good thing. In sentiment, last time we were talking about how people were optimistic, and now it's like outright bubbly. It's we have these sentiment indicators are hitting the highest level in history. In the U.S. market, there's not been a 3% correction for over a year, which is unheard of. There hasn't been a 5% correction for like 19 months. So the consistency of the market plugging along has been really remarkable, and it's given people all sorts of confidence as far as their sentiment is concerned. So that is not a good thing. The best time to buy the stock market is when it's cheap and people are panicky. Right now, the market is expensive and somewhat bubbly. So, but the fact that the economy is so positive says to me that, sure, we might have a correction here, but once this valuation sentiment, if we have a correction, it won't be the beginning of a huge decline. It'll likely just be a pullback. And if we have money on the sidelines, we should be putting it back in to take advantage of the next upswing in the market. So the growth objective, we're now at 60%. So we're below the normal minimums. And if the market keeps on going up, I think that we might even be less in the market. The balanced objective over here, we're now at 40% stocks. And once again, we'll likely be heading lower in the future if the market continues to go up. The areas we're getting involved in mainly are Canadian banks, U.S. technology, and the general global markets outside of North America. In the area of fixed income, we are not in basically the bond market. We have preferred share ETFs and the alternatives, HGC, which, by the way, HGC's alternative fund just reported yesterday that they made 1% last month. Once again, as far as an alternative to the bond market, it's doing absolutely fantastic. In the balanced area, we do have the prefers plus the alternative and a little bit in the short-term corporate bond type of fund. So let's take a look at the shifts we've made in the last quarter. Okay, we sold Europe, and I moved to a global ETF, non-US. So anything outside of the US. That includes Europe, so that Europe is still there, but not a pure Europe fund. And it has things like China, Far East, Australia, Japan, emerging markets, etc. So it's more or less global outside of Europe. And what's happened in the last while is that as Trump is getting bogged down with his Make America Great campaign, then it looks like what's happening is the global markets outside of the US are starting to outperform the US market. So to take advantage of that, and that, rather than pick individual areas like Japan or China or whatever, I decided to just take the whole group, and I think that will give us a decent rate of return. We reduced the NASDAQ tech type ETF and put some money in the U.S. healthcare. When the repeal of Obamacare was aborted, the healthcare stocks look like they could do very well going forward. We sold some of the Canadian short-term bond fund, and we put some money into more Canadian banks. In fact, TD Bank and Royal. One of the key reasons I did that to buy individual stocks is that we were selling a US type of ETF, and the TD Bank and Royal Bank trade on the New York Stock Exchange, so we were able to take those US dollars and put them directly into TD Bank and Royal Bank by buying them on the New York Stock Exchange. And that way we saved the exchange rate that would have been charged. And these two stocks are outperforming the Canadian Bank Index, so they fit the bill as far as momentum. We bought more of the alternative investment, HGC, and we bought more of the preferred share ETF. And I'll show you later how well they're doing. And for the balanced folks, we got out of the short-term bond ETF and bought this floating rate short-term bond fund. And it invests in deposits of corporate credit, short-term paper. So when we're looking at the winners and losers, there actually wasn't a lot of standout performers. They were all doing well, relatively well. The portfolio influences this quarter. This is from the June to the end of September. And what really stands out is this Canadian Bond Index ETF. So that is the short, medium, and long-term bonds. They're government bonds, they're provincial bonds, they're corporate bonds. So it's a whole bond index, and that's what people measure themselves against as bond portfolio managers. And what we see, including in the interest earned, it lost 2% in the quarter. So you can lose money by owning bonds. And that's because when interest rates are going up, the price of the bonds fall. You know, if you have a 5% bond, in a 5% world, it might be priced at 100 cents on the dollar, but in a 10% world, people won't give you 100 cents on the dollar for that bond because they can buy a bond and get 10%. So they would give you less money, and by giving you less money, they will earn 10% by getting the coupon plus some capital gain. So as interest rates go up, bond prices can fall. So we are avoiding this kind of decline by owning some of the other things, which we do in lieu of owning bonds. Now, the big performer in the quarter was the TSE up here. It was up 4% in the quarter. Most of the quarter was doing nothing, but then the last week or two, it shot up. So here's where we have the growth target here, which is a combination of bonds and stocks. And the balance target is in here. Once again, a different balance. The US stock market recovered to have a small gain in Canadian dollars. And a lot of this was due to the Canadian dollar going up. So, and in the last few weeks, it's gone down. So somewhat of a recovery there. But that is kind of the hand we were dealt as far as the performance of the various areas of the financial world. The Canadian dollar pulled back from over 82 cents to slightly below 80. So now we looked at the Canadian Bond Index, which was down. Even the short-term bond index was down. Laddered preferreds have gone up. That's the preferred ETF. I'll be talking about that. Now, when interest rates are going down, it goes up. It's a great hedge, and I'll show you why that happens. For the balanced people, I put some money into this Lysander Canso short-term floating rate fund. This is the Canadian Bond Index down 2% here, and this fund just chugs along and earns interest. These are super short-term deposits that we own through this Lysander. So the interest rate is renegotiated on a regular basis. It's like these companies are borrowing money at the bank and we're lending it to them. So it's, I think we don't have to worry about the bond market falling when we own this. It's a way of getting some decent interest while we're waiting. Now the Laddered Preferred, we own some of it at the beginning of the quarter. It's gone up. We bought some more here, and we bought some more recently, and it's gone up some more. So, you know, going up 2.5% when the bond market goes down 2%, this has been a dramatically better investment than owning a bond. So I feel really good about that. And I think that as interest rates go up in the future, we'll see potentially the same type of action, where as interest rates go up, the bond market will do poorly and the preferred share will go up. Now this is from the Bank of Montreal website on our investment here. That's the Laddered Preferred Share. And I want to talk about it because we do have a lot of it. In the growth, we have 20% in it, and in the balance, we have 30% of the total portfolio in this investment. So it's a very big holding. So I want people to be really clear about what they're holding here. So it's an ETF, and they hold 184 different securities. The size of this fund is $2 billion, so it's huge. Now, what it owns is preferred shares that are what's called rate reset preferreds. Now, a preferred share pays an interest rate, not interest rate, but a dividend rate. And they're issued by companies. And if the company ever goes bankrupt, the first assets realized in a bankruptcy go to the bondholders. If there's anything left over, and next it goes to preferred shareholders. And after that, it goes to the common shareholders. So the preferred shares rank after the bondholders. So it's a lower quality than owning a bond. Now, these preferreds have a set interest rate, a set dividend rate for 5 years, each one of them. So there's 184 of these, and these were issued at different times over the last 5 or 10 years. So this ETF buys these, they're holding them, and each one of these has an anniversary date, which will reset the dividend yield. And the way it's set is predetermined. Back in the beginning of this, they were 2% above the 5-year Bank of Canada rate. So back then, the Bank of Canada rate was at 4%. So 2% above that meant that it started out as that a certain one would have started out as a 6% dividend rate. But as interest rates fell over the last next 5 years, all of a sudden the 5-year bond was at less than 1%, but let's say 1%. So resetting at that point, you would get 2%, which is a spread, plus 1%, 5-year Canada. So you get 3% instead of before you were getting 6%. So you can imagine that these preferreds would go down in price because you start off with a 6% preferred, and all of a sudden 5 years later it's reset at 3% for the next 5 years. So sure enough, these rate reset preferreds were a terrible investment for a long time. This shows here the growth of $10,000, and it went from $10,000 down to, let's call that $6,000. So it went down 40%. Now, it wasn't because the credit was bad. None of these went under. In fact, these are issued basically to banks and the highest quality companies in the land. But because interest rates on the 5-year Canada were going down, 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 and every time any one of these were reset, they got lower and lower and lower and lower, then the shares went down. But flash forward at this point, and I got to tell you, none of my clients, I didn't buy any of my clients this when it was falling because I thought it was a terrible deal. And I actually lost a couple of clients because their other brokers were telling them to buy these things, and I wasn't. And yet, they turned out to be a terrible investment until interest rates start to go up. It's the opposite now. In the last 3 months, the 5-year Canada bond has gone from 1% to 2%. Okay, so things that are being reset now are higher than they would have been expected before. So we're in the opposite world. As interest rates go up, every time one of these is reset in the future, people will get more than they expected now. Now, this is also called laddered. Okay, laddered. What does that mean? It means they own reset preferreds every year for the next 5 years. So in their portfolio, 20% of them are going to get reset over the next year, 20% over the following year after that, 20% over and the last one is 5 years hence. So they're not guessing which is the best ones to own. They're just taking it so that in the future they'll always be reset because they own 184 of these things, and they spread them out so they're being reset all the time. So the dividend yield will go up over time as interest rates go up. So the and here's what they own. If you take a look at the top 10 holdings in what they have, it's like Enbridge is the largest pipeline company in the world. TransCanada Pipe, once again, large pipeline company. Toronto-Dominion Bank, more pipelines. Royal Bank, Canadian Pale Bank, Royal Bank, Royal Bank. They're extremely safer than normal companies because, you know, the only people that could issue these were extremely safe companies because nobody would buy one of these rate reset preferreds from Bombardier or something because you're locked in forever if you own one of these until you sell it, of course, but it doesn't mature in the future, and the credit quality is super important, that sort of thing. So the quality is higher than normal, but as a preferred, you know, they say it's lesser quality, you know, and I would say for sure if I bought a preferred of a normal company that would have a higher risk of bankruptcy, I would be worried about my ranking in a bankruptcy. But looking down the client list, the issuers of all these 184 preferreds in this fund, it just doesn't look to me like that we're going to see a bankruptcy of any of these. Now, that doesn't mean that somewhere in the future, you know, we could have a banking crisis in the future. But we can also sell this, and I'm going to be watching for this. We're temporarily buying a lot of this. If I thought interest rates were going to go down, let's say we hit a recession in the future, and the interest rates are going to start falling, that's where we would switch from this to a bond that profits when interest rates fall. So unlike other investment portfolio managers that buy and hold things forever, if the outlook changes for interest rates, we will change our portfolio. We're looking at the economics, we're looking at the outlook. We're not just blindly holding on to things and riding a roller coaster. So we're holding an extraordinarily high amount of this particular fund. And by the way, it yields 4%. And bonds nowadays are yielding a couple percent. And also there's a dividend outside of an RSP or registered plan. You get a dividend tax credit that increases your rate of return by about 25%. So a 4% yield is equivalent to a 5% bond yield. Now, even inside of a registered plan where you don't get a dividend tax credit, it's still a great deal, 4%. Cecilia would be putting these in your non-RSP account to take advantage of the dividend tax credit. So sorry to dwell on this a lot, but it's unusual that we'll have this much in this in preferred shares. And I want you to totally understand it. If you have any questions whatsoever, promise me that you'll call me about this, because I want you to be totally understanding the risk reward on this investment. So I won't go over the charts on all the various stocks and ETFs that we own, but they generally look like this. You know that my momentum streak says I'm looking for things that are outperforming the market. Here is the Dow Jones Trust. Almost all the charts look like this, where the ETFs we own are doing better than the stock markets. And that means that anything over zero here means that over the last 9 months, this ETF is outperforming the US and Canadian stock market. And since the last sentiment low, August 18th, it is outperforming as well. So the leadership is still there. So this is the type of thing where we see in the things we're holding. And what we are holding is we have the bank ETF that holds all the top 5 banks. Then we have more money in Royal Bank and TD Bank. So large holding there. Altura, for those people that own that, we have that as a thing, and they're at a critical drilling stage here. Healthcare, I said we bought some, about 8%. We still have the Internet ETF, Momentum ETF, and this is the All World X the United States, as I talked about. And we still have some of that technology-weighted NASDAQ index. So looking at this up close, because having money in the right areas is key to performance. We have here the our portfolio is high on financials, which is basically banks. So we have the Canadian banks, plus we have some banks in those other indexes, like the Global X the US has banks in their index. This is higher than even the Canadian stock market, and quite a bit higher than the US stock market. So this is our key area. It's a high dividend yield area, and it's a leading stock group. We have those people that have Altura have some money in energy. Healthcare is about the same as the US market, much higher than Canada. Information technology, we reduce that a bit, but we still have a fairly high weighting compared, much higher than the Canadian stock market, but less than the US market. But I would say that we have healthcare and information technology and financials is the key. As far as the exposure, currency-wise, we're 40% in US, 40% in Canada, and 20% in the rest of the world. Now, the Canadian stock market has a very large amount in energy, and energy recently has had a jump. At this point, I'm not really comfortable in buying energy, as far as the long-term outlook and some of the constraints the government's putting on pipelines and such. So if the market is streaking higher in Canada because of energy going up, we could be lagging for that reason. Altaria is a totally different situation. It's more of an exploration situation. But back in the day, at the bottom of the stock market last year, we had a lot of energy, but I'm just reluctant at this point. As we get closer to the end of this stock market cycle, I want to get more cautious. Now, as far as the non-equity area for the growth investors, on a hypothetical $1 million portfolio, we have $600,000 in the market and $400,000 out of the market. And what we have is $200,000 in the rate reset preferred and $200,000 in the arbitrage fund. And both of those are doing much better than if we had money in the bond market, which is the more normal approach. Now, in the case of the balanced objective, we have only 40% in the market, and we have a large amount, 30% in the preferred fund, 150% in the HGC fund, and we have 150,000, 15% in that corporate deposit fund. So that's this a little bit of fixed income is the difference in approach between balanced and not. So then we come to this, which is how we might, over the next period of time, potentially try to miss a downswing. If there is going to be a downswing in the future, in the past, we've missed them all. Basically back in the tech bust, when the market fell 50%, we were up. Amazingly, in 2008-9, when the market fell 50%, my clients were up 8%. And then we had the party back in 2016 because we were up 8 or 9% when the market fell 20. So that begs the question, well, this one was because we did so well in 2016. So that was an up celebration. So at some point in the future, we might see the market fall. And it begs the question, how are we going to avoid it? And so I'm keenly watching that. I had summer students working and analyzing and sort of working on refining the strategies which I've used over the last few years to avoid these declines. And newer clients might, early in my career, I went through a boom and bust in Calgary that was devastating. Incredible boom, incredible bust. And it made me paranoid of declines. And so I've done a lot of research around how to avoid them. And so this is what has created these good situations when the market's fallen. And so I'm thinking that we're getting closer to one of those finally. I've been very bullish until most recently. So we did reduce our equity exposure back in 2000 and or back in March and July. So that's one way of potentially avoiding a pullback. The other thing we're doing, we just put in, is a stop loss on a couple of our ETFs. So this is how this works. We're tracking daily the the NASDAQ Index ETF and the Internet ETF. This is them over the last year or so. And I put in a trend line here, which is a running trend line, which is the average price over the previous 100 days. So every day you put a new price on and drop a price 100 days ago. So this is a slow moving trend line. And so what we're doing now is, if and when this was, for instance, to cross this line, we would sell this ETF. So if it continued to fall, we would be out. So we have this mechanical way of selling this. Now, it might just keep on going up for another 6 months or a year, who knows? If you look back here, this line back here was at, let's say 115 or 16. Now it's at 140, you know. So there's a 30% gain from here to here without getting out. So as long as this is going up, we're in it. And when it starts to go down, we'll sell it. Now, also in taking the money and putting it into an alternate fund, which is a hedge against the stock market. So we'll take that money and use that money to hedge against the other stocks we're holding, to protect those if the market continues to go down. So this is the type of thing we did in 2008, which dramatically, we were up when the market fell 50%. So we haven't used one of these stop loss techniques since 2008 because it wasn't necessary. It hasn't been necessary over the last 5 years or whatever. But the closer you get to some peak in the market, the more you want to protect your gains. And this is what we'll be doing. And also, when the market does fall, we can take advantage of low prices by having money out of the market. And so that gives us a great opportunity to not just ride the ups and downs, but take advantage of the ups and downs. So that is what's happened over the last 3 months, and some of the things we're doing now to protect our gains. If you have any questions, well, actually, what I'm going to do, I have been recording this, and